And one of the great advantages we have for clients here, and it's open to all of you guys, is they call him the tax doctor. And I'll let him talk about some of his expertise, but I've never known a guy that knows more about what's going on with the tax system now and what might happen going forward. So anytime I get a chance, when I go to the select advisor meetings or whatever, the first guy I go talk to is Dean, because he always knows what's going on. He knows the inside, even the Obama stuff, which is still incredibly hard to figure out. He knows it. So please welcome, live from Philadelphia, and he's a very shy guy, Dean Mioli.
Thank you, thank you. Well, good evening, everyone. I'm going to try to make taxes as interesting as possible. Okay, and I know you're all having glasses of wine and so on, but we'll do a good job for you. You'll see. We have a lot to cover, and in actuality, I am actually going to review line items of your tax return tonight. So something you're going to learn tonight, you can actually go back and look at your own tax return. Better yet, have Integrity look at it for you. Okay. And if Bob has any questions, Scott's got any questions, they can come to the tax doctor. Who likes to pay taxes? Joe Biden in the room? I don't see Joe Biden. So outside of Joe, I think most of us would be just as patriotic if we paid less taxes than we do now. Okay? So we're going to talk about that. We're going to talk about different types of strategies. I have a strategy for you that we're going to talk about. Charitable trusts. Complete renaissance going on with charitable trusts under this new tax law. Very powerful tax saving strategies. So let's get into this. First, a quick review, because I'm going to tell you that the tax law that got put into place in January of 2013, complete sleeper. No one was talking about it. Okay? April 15 comes this year. Guess what? Sticker shock. My income didn't change, my deductions didn't change, but I owe $12,000 more. How does that work? Tax law changed in a major way. We went from about a 4 in tax complexity to about a 9.5. I used to be able to do it in my head. No way now. Much too complicated. Much too complicated. In fact, if I was a CPA, I would have doubled your bill this year. Even if I lost half my clients, I still would have been happy. Same amount of income. Half the clients. But this is what we're dealing with, ladies and gentlemen. Top new tax bracket, 39.6%. If you happen to be in that lucky crew, guess what? Your long-term capital gain rate, qualifying dividend tax rate, 20%. But that does not include the new Medicare surtaxes as part of the Affordable Health Care Act, add another 3.8% on top of that. So really, long gains, qualifying dividends, 23.8%. Also, a backdoor revenue raiser, phase outs of your personal exemptions and your itemized deductions. This really hits families with kids, okay? You could lose all your personal exemptions, and you could lose up almost all your itemized deductions. You can't go below your standard deduction. Brutal. And if you get into the phase outs, that's adding 1% to your marginal tax bracket for each exemption. And of course, if you start getting phase outs to your itemized deductions. AMT. Alternative minimum tax. Okay, the bane of our tax system. Not going anywhere. Why? It's a huge revenue raiser. You know, our tax system is kind of a dual tax system. We do a regular tax calculation, we do an AMT calculation. Guess what you pay? The higher of the two. Okay? And right now, middle America, a lot of middle America pays AMT. When I review returns, I would say 80 to 85% are an AMT. Now, if they're in New York, New Jersey, California, just to name a few states, 100% AMT, because the state taxes are so high there. Okay? Incredible. That's not going anywhere. There's no way the Democrats would ever sign off on AMT getting repealed, because they say, well, where's the revenue coming from if these people aren't paying? That's got to stick around. Okay, so let's take a quick look at the tax brackets. You'll see where that 39.6% bracket comes in. For a married couple, $457,000 of taxable income. Kind of a little quirky thing. If you look at the 35% tax bracket, I never saw a tax bracket so small, $1,700. Even this bracket's kind of small, $55,000. Most of the time it's usually $100,000, $150,000. They'll have to rectify that. But that's the tax brackets for this year. Okay. Now, one thing that has got much more complicated is capital gains. We have now 4 4, mind you, capital gain rates. 0, 15, 18.8, and 23.8. And this is really gets really kind of interesting. We're really 3 brackets, 0, 15, and 20, and that's based on taxable income. And you can see the income levels, depending if you're married or single, where those brackets come in. Then because of this Obamacare, we have this Medicare surtax to deal with, which is based on adjusted gross income. This is why it's getting complicated. You have AGI over 200 or 250. By the way, AGI is before taxable income. You could get bumped up to 18.8 or 23.8. This brings in some planning ideas. One is, if you happen to be in the lucky category of having a low tax bracket, you could actually harvest long gains. Let's say your projected taxable income this year was $50,000. You could harvest $23,000 in long gains, pay 0 federal income tax. Not bad. Not bad. But if your income is moving around and you have some control over your income, meaning, let's say, if I could harvest gains this year and pay 15%, if I wait till next year I pay 23.8, I actually may want to accelerate income. So if you have control over your income, it is kind of important to see when it might be best to recognize income. Okay? I used to think doing a 2-year tax projection made a lot of sense for people. Now, if you have a semi-complicated situation, it's 5. And if you have a complicated situation, you need to plan out 10 years. Because it's all about managing your tax volatility. We talk about investment volatility. Each investment has some volatility to it. But to me, I don't want my natural tax rate disturbed. Especially, I don't want any upward volatility. If you have a big spike in income in any one year, you will get destroyed. You will absolutely get destroyed. We don't want that to happen. We want to manage income and recognize income over several years. And we'll talk about strategies to do that. Now, for most people, when it comes to capital gains and losses, line 13 of your 1040 is where that line talks about capital gains and losses. There is a magic number for that line. If someone knows that, then we'll see. We're going to have a little test. What should be the magic number for your total gains and losses for any particular year? What should be the magic number there? Especially if you don't want to pay tax. And this is for 90% of the investment public. What would you think a good answer would be? Shout it out. It's okay. You'll still get wine and still get sandwiches. It's okay. You won't be asked to leave. 0? How about 0? Zero is a pretty good answer. 0 is a pretty good answer. But actually, there's a slightly better answer. For most of us, trying to get to a minus 3,000 is actually the best answer for that. Why? Because you're allowed by tax law to offset all your gains and then an additional 3,000 more. Now, if you're in a 35% tax bracket and you harvest that extra 3,000 in gains, you just saved $1,000 in tax. That's not bad. I think that's worth the effort. I know Integrity certainly is going to look at that for you. Okay? Very important. Now, again, most of the time that's what the number you're going to strive for, but you have to be careful in this particular state and New Jersey, because let's say you harvest $100,000 of losses in excess of your gains. Now, for federal tax purposes, that's okay because there's an unlimited carry forward provision. So if you don't get to take them this year, you can offset gains in future years. But in Pennsylvania and New Jersey, they don't have those carry forward provisions. You use or you lose. Now, Pennsylvania is only a 3% tax. Not a big deal. New Jersey's over 9%. I've seen some very bad advisors harvest excess gains and then they wind up losing them for state tax purposes. Be cognizant of that. Okay? Now, we'll talk about these new Medicare surtaxes. There's 2 of them, 2 mind you. One is on earned income, and it applies to earned income, and it kicks in when you get over $250,000 of earned income. And what happens is, Social Security is really made up of 2 parts. You have the Social Security part, and you have the Medicare part. The Social Security part, 6.2%, tops out at $117,000 of income. The Medicare part, 1.45%, no ceiling. You make $100,000, you pay it. You make $20 million, you continue to pay it. Now, of course, the employer is paying the other side of that. If you work for somebody, they're paying the 6.2 and the 1.45 as well. But this new surtax, when you get over 250,000 or 200 if you're single, it goes up from 1.45 to 2.35, 90 basis point increase, and the employee pays it all. Employee pays it all. It's rough, okay? And if you're self-employed, not only do you have to pay it all, you don't even get to deduct it. How about that? Okay, and I'd snuck up on a lot of people. Let's say you have a husband and wife working, both making about $180,000. Certainly they're over the threshold of $250. They're at $360. Neither employer was responsible to withhold that tax because neither of them were over the threshold amount. So when they filed in April, guess what? They owed. And they might have incurred a penalty too. How rude was that? Now, we also have a new Medicare surtax on investment income. Covers taxable interest, capital gains, rents, royalties, annuities. You can see why zeroing out your gains can be important, because it is subject to this tax. Now, what's not on this board? There's a lot of things on this board here. How about municipal interest, municipal bond interest? Not subject to federal income tax, and if you buy a PA bond, it's not subject to PA income tax, and it won't be subject to this 3.8% surtax. So if you're going to own fixed income, if that makes sense for your portfolio, and it's non-qualified money, standard brokerage account, munis can make a lot of sense because the hurdle's pretty high. I mean, if you're at 43.4% tax, your corporate bonds or your high yield bonds are going to have to pay a hefty yield to outweigh the municipal interest, which is tax-free. So there's going to be a lot of tremendous appetite for municipals going forward, even though, granted, yields are low now. Not going to stay there forever. But they do make a lot of sense, okay? They can make a lot of sense. Unfortunately, more and more people are going to be caught up in this surtax because the threshold amounts are not being indexed for inflation. So you might not be in it now, but guess what? It's in your future, okay? Now, this is a lot to navigate. This is why things are very complicated, because you have phase-ins of the surtax, you have the phase-outs of your itemized deductions and personal exemptions, and you have the phase-ins of these new higher tax rates. It's like flying under the radar of these things, okay? I need a GPS system. I mean, it's rough, okay? It is rough out there. There's a lot to be taking into account. And of course, you don't want to experience these things. So that's why having good tax planning makes a sense. This is our tax system on one slide. This is why I would double your rate. If anybody questioned me what I do for them as a CPA, that's what I do. I navigate this. Okay. This is tough. You have ordinary income rates, AMT rates coming in at all different levels, long-term capital gain rates, taxes on wages and earned income, net investment income tax, phase-outs, AMT exemption phase-outs. Multi-dimensional tax system. It is brutal. We did not get tax simplification, ladies and gentlemen. We got tax complication. It's good to be a CPA. Double your fees. This is rough. Very rough. Okay. Now, we're actually going to review a 1040. I'm going to show you one of the services that we provide our advisors, such as Integrity, on how we help their clients manage tax. Because we're one of the preeminent providers of tax managed solutions. From a common investment standpoint, I don't care what I make up here. I want to know what I get to put in my pocket. Investments is about compound returns, and you need to keep what you make. And paying less tax is something you can control if you take an active part in it. And tax is a matter of fact. Tax is a matter of fact. Investments are a matter of belief. Okay? There's a big difference between those two things. All right, here's a hypothetical 1040. Married couple, just two exemptions, husband and wife, wages of $285, taxable interest $8,445, tax exempt interest $2,500, dividends $12,888. Some of them are qualifying. Capital gains, line 13, $36,000. So their AGI $342,000. Be curious how these slides build. Okay, they build. Okay, good. 342. Their itemized deductions total about $37,000. By the way, they were limited. They were subject to phase out. It was over $39,000 prior to phase out. Personal exemptions, $5,100, but if they weren't subject to phase out, it's $3,900 per. So $7,800 reduced down to $5,100. They're an AMT. Well, total taxable income $299. They're an AMT, $3,600, line 45. So you add that to the regular tax to come up with their total tax, but that's not quite done yet because they had to pay those new taxes, those new Medicare surtaxes on earned income and on unearned income. Total tax bill, about $74,000. $74,000. You ever think about paying federal income tax on a monthly amount? Because most people think things about month. What's your car payment? Oh, it's $500 a month. What's my mortgage payment? Oh, it's $3,000 a month. Well, your federal income tax bill, what's about $10,000 a month, roughly? Would you like to save? Would you like to pay less than that a month? Do I have any hands for that? Can I get a hurrah? Yeah. Okay. Well, we're going to work on that right now. We're going to work on that right now. Okay, let's look at the first line item. We're going to look at taxable interest. They're in the 33% tax bracket, and they're subject to that Medicare surtax at 3.8%. They have taxable interest of $8,445 from bank accounts, from brokerage accounts. They're invested in high yield bonds, emerging market debt, tax inefficient fixed income. Okay. What if we converted those types of investments to municipal bond interest? From taxable interest to tax exempt. That's one strategy. Well, if we did that, instead of paying 36.8% tax on that $8,000, we would save $3,100 in tax. Okay, that's one strategy. Now, you might say, well, maybe I needed those in my I need those investments, emerging market debt and high yield bonds, or et cetera. Bring up the concept of asset location. There's asset allocation. How much do I put in stocks? How much do I put in bonds? How much do I put in commodities? But where do I own those things? Because again, it's all about after-tax return. So if I have a tax-inefficient investment, such as high-yield bonds, and I have an IRA or a 401k or a Roth, maybe that's where I should own those things, because you don't pay tax on those accounts, or they're tax-deferred. Whereas this, I have to pay tax. It's in a non-qualified account for standard brokerage account. So either you move it to the right bucket, or you own a tax-efficient investment in your non-qualified account.
Doesn't that savings assume, though, you get the same rate on the municipal bond as a taxable bond?
Well, that's a great question. You have to compare after-tax yields. So if the muni's paying 3, and before we start this computation, if the taxable bond pays 4.5 after tax, who pays more? So that would be, for instance, comparing your municipals to high-grade corporates and treasuries. But that's a great point. The other part...
Rate by 0.64 or whatever.
Yeah. Why don't you, Scott, bring that, give me a tax equivalent yield on, get your calculator, I don't expect you to do it in your head, on a 3%.
I did enough of those.
A newly minted CFP over here.
Thank you.
Certified financial planner. Now that's one question, whether it's, if I'm going to keep my investments in my non-qualified account, what's the better after-tax yield? Point 2 was, well, maybe I just own those in a different account.
Right. So
there's 2 ways to look at that. So you make a good point. I would do both tests. One is, can I get that same after-tax yield in my non-qual account? And munis are paying pretty competitively right now. In fact, they're paying more than treasuries. So in that case, I'm arguing, and plus they're state tax free, so you have to take state tax rates into calculation as well if you buy PA bonds. Or you own them, those other bonds in the IRA accounts. 2 is, believe it or not, some municipal bonds are taxable. Do you ever think of that could happen? But brokers are not very cognizant of this issue. Because the client will say, I need municipal bonds. So they call their bond desk up and say, oh, Mr. Client needs municipal bonds. Oh, sure. We'll push some down into his account. Of course, they step on them. They mark them up. They put a nice little markup, which they don't disclose, by the way. And if they were the type of municipal bonds called private activity bonds, and if you're an AMT, guess what? They're taxable. I want tax-free bonds, not taxable bonds. Private activity bonds are like nursing home bonds, sport facility bonds. They're like municipal bonds in drag. I knew a congressman who would give me a favor to get these classified as a municipal bond, but they're not really a municipal bond. This person, when I looked at their return, I see that combination, tax-exempt interest, they're an AMT. I go to the AMT form, I go to that particular line item, $1,500 of that interest was AMT bonds. So if they would replace those AMT bonds which by the way are typically lower quality, with better municipals save $420. I've looked at one line item of this tax return, I found $3,500 in tax savings. Do I have your attention? Okay, because it's getting better. It's going to get better. Okay, and this is an annuity. You find tax savings on 1 year and you continue to do this year after year out. How many years do you want to go out? What discount rate you want to use? This could be a lifetimes of savings here. Lifetime. Okay. And you might say, well, why is my CPA telling me this? Well, first of all, they're not investment experts. And how often do you see your CPA? Most times once a year. And tax season's very compressed now. It's about 6 weeks. All they're thinking about is getting those returns done. And you can't do much tax planning during tax season because the tax year's over. 2013's over. Everybody's on a calendar year. So if you don't get it done by December 31st, you're talking about 2014. Okay, let's look at another line item. Dividends. What's concerning me here, again, is the tax efficiency of the investments. $12,888 total dividends, only $30,888 was qualifying. In this particular case, a qualifying dividend is taxed at 23.8, an ordinary dividend 36.8. That's a pretty big delta. Again, what it talks about to me is the tax efficiency of the investments that they own. So you have to be careful with that. Again, it talks about where do I own certain mutual funds. Doesn't mean a manager's bad just because they're tax inefficient. But if I want to own that manager or that fund, park them in an IRA or her in an IRA, not pay the tax bill when I can defer the tax bill. Okay? Very important. Again, asset location. And if you're going to own managers, equity managers in your non-qualified account, there's certain types of funds that are better than others. Growth funds or buy and hold managers, okay, better to own. Okay? Keep that in mind. Let's talk about capital gains. You probably all know the answers to this one. Again, I got a problem with this. $36,000 of capital gains. So when I see that on a tax return, I said, let me see the year-end brokerage statement. Could there have been there something that I could have sold that could have generated a loss that would have offset those gains? Now, when I did that review of the brokerage statement, I found $12,000 in losses. So that broker was asleep. He should have harvested those losses. And if he had done that at 18.8, which is the long-term capital gain rate, would have saved $2,200 in tax. Now, I couldn't find, I could have made this even a bigger example, but I thought that would be kind of cheesy. I could have found $39,000 in losses, but realistically, that may not be there. Point is, you need to look at that year-end brokerage statement. Now, during the year, we take a very active view of capital tax loss harvesting, because you never know what the year is going to be. You never know when it's the best time to do it. You look at it year-end just to kind of true things up to see, hey, do I want to recognize gains? Do I want to recognize losses? What should I do? Okay. 3 line items of the tax return, close to $6,000 in tax savings. Okay. Kind of interesting. The largest return, real return that I looked at and found tax savings on was over $700,000. Real live case. I look at the president's return every year because it is public information. And it's a pretty clean return because this is presidential salary now. But he is an author. He has books. And he has a Schedule C, sole proprietorship. And for the last several years, I've been writing to him. I say, hey, you're the leader of the free world. Set an example. Save. I know you're going to make a lot of money when you're president anymore. You're going to write books. You're going to go on a big speaking tour, etc. Okay? Maybe join a lobby firm of some sort. I said, you could be putting $49,000 into a retirement plan. Okay? So last year, he finally did it. And he wrote to me. And guess what he's doing for me? I'm getting audited. That's the last time I helped a Democrat. I'm telling you right now. Now, kind of funny, because when he ran against Mitt Romney, I looked at Mitt Romney's tax return. Now, the Romneys are very wealthy people. Very wealthy. I never thought I'd see a return where someone had $21 million of adjusted gross income and paid alternative minimum tax. That's absurd. Why did that happen? Because most of his income is all tax favored. It was all long gains, being taxed back then 15%. Dividend income, again, 15%. So I looked at his return and I found over $1.5 million in tax savings. He doesn't do tax loss harvesting, doesn't handle charity right. He's very generous. They're very generous. They gave like $3 million in charity, but they give a lot in cash. And cash is a very tax inefficient asset to give to charity. You're much better giving appreciated securities. Because if you have to sell the security to write the check, that's not good. You have to pay tax. If you sell the security at a gain, and you don't want to gift your losers, that doesn't make any sense. So there are smart ways to do things. I like to work in the tax smart world. I don't like the tax tail wag the dog, so to speak, but before I do a transaction, I want to understand what the ramifications are. Okay? So there are things that we can do, okay, to manage that tax bill. Of course, one thing brave basic is if you're still working, make your IRA, 401k, 403b, 457 plan, whatever it might be, maximize those contributions, okay? Especially when you're paying 39.6% tax. Let's talk a little bit about Roth conversions. And here's the idea I'm talking for you, because I did the same thing with my father, and so I'm going to give Newland this idea. Maybe she'll do this with you. I walked up to my father a couple of years ago. I said, Dad, I want you to do a Roth conversion. Now, my father's retired, over 70 and a half, doesn't have a mortgage payment anymore, Social Security, pension, etc. I said, I want you to do a Roth conversion. And he said to me, well, Dean, you've taught me, there's going to be a tax bill associated with that Roth conversion. I said, yes, it is. There's definitely going to be a tax bill. But I am going to write the check for the taxes. I am going to gift you the tax dollars to pay for your Roth conversion. Now, I am a good son. Very good son. But there's any other reasons why I might want to do that?
You're the beneficiary of the account.
That is correct. That is correct. But if I were to do a Roth conversion, my wife and I, we have very good careers. Our tax rate's up here. My father's tax rate is very low, 15%. So I'm basically getting a Roth conversion done on the cheap. Because eventually, those accounts will come to me and my sister. And I'd much rather inherit a Roth than a taxable. Because if I get a traditional IRA and I'm required to take minimum distributions, whether it's a Roth or not when you inherit it, I'd much rather have tax-free income at my level than taxable income. Generational arbitrage, we call that. So in your case, you should think about doing a Roth conversion and have her pay.
Give the money to me.
Oh, there you go. There you go. Because it makes a big deal. When you think about this concept of Roth conversion, you really have to have a little bit of vision. Because if you get the tax man out of your pocket doing this Roth, he's out forever under current tax law. And I don't see this changing. And not only for me, but if I were to die and my kids were to inherit it, it's tax-free to them. This tax-free thing goes on a long, long time. I like tax-free. I like the sound of that. You should too. And when you're doing financial planning, you really need 3 tax buckets. You have your taxable account, you have your tax deferred, and you have your tax-free. I like a hot shower in the morning, but I have to put in a little cold water in there. Otherwise, I get scolded. If you don't have a Roth account, you're going to get burned on your taxes. You need to have access to tax-free cash. You should always be looking to do Roth conversions. You never know what's going to be the best time. Tax volatility. Let's say you lost your job temporarily. Your income's way down. Perfect time to do a Roth conversion. Okay? Something, when I got married 5 years ago, my wife always had a 401k, never put money into an IRA. So when we got married, again, we looked to do, we're good savers. That's how our parents taught us. We save a lot of money. And we can't do a traditional IRA deductible because we make too much. We can't do a Roth directly because, again, we make too much. Can I still contribute to an IRA? The answer is absolutely yes. There's things called a non-deductible IRA contribution. So every January, I get the checkbook out, and my wife makes a non-deductible IRA contribution. Week later, the check clears, always clears, and we convert it to a Roth. Now, mind you, she had no existing IRAs. Guess what the taxability of that transaction is? 0. We call that Roth through the back door. Little loophole in the tax law. Again, something to take advantage of. If you have kids that are working now, question,
Can you just explain that more? So if you actually make the non-deductible contribution, 6,000 per se, and then what, take me through that next step where there's no.
Sure. In the case, in the case of my wife, she has no existing IRAs. This is a critical point. So she can make a non-deductible IRA contribution. First, if we could do a Roth directly, we would. If we could do a deductible IRA, we would. They're just not available to us. So we go the non-deductible route. And with a non-deductible contribution, you have basis in that IRA. So when you convert it to a Roth, there is no taxability to it.
But you have to do that transaction. How long does the IRS make you wait before?
As long as when the check clears.
That's it?
That's it.
But you can't have an existing IRA.
Let's say you did. Let's go through that example. Let's say I had a $5,000 IRA, and then I made this, where I actually did deduct it, and then I did a non-deductible contribution for $5,000. And then I converted the whole thing. Then $5,000 of that would have been taxable to me.
With the existing IRA, whatever that.
Yeah, which to me is not a bad thing, because I'll tell you why. What does that set up?
Bigger IRA, and you didn't want to make a smaller deduction, it wouldn't work with it.
That's right.
The whole thing gets pulled.
That's right, because it's done on a pro rata basis. So if I had a small IRA, 5, 10, 15,000, I think it's worth doing this.
Yeah.
Now, if I had a $100,000 IRA, no, you're not a good candidate for this. Okay, you're not a good candidate for this.
Now, normally you have to be, it's only income from your occupation or your job.
Yeah, or Schedule C, if you had like a sole proprietorship.
If you're
Even alimony, by the way, is considered income,
if you're
earned income.
retired, you cannot do this based on investment income, is that
No,
correct?
no, you have to have earned income. You have to have some kind of
has
earned
to be
income.
earned income.
Divorce him and he pays you alimony, that's earned income.
That's earned income?
Yes, it is. Yes, it is. So that could be a tax angle here, I'm not sure.
You're making him look nervous.
I'll get you married back again, don't worry. So again, these Roth conversions are kind of interesting because sometimes you compare it with another strategy like increasing your charitable contributions. And you don't have to do the whole IRA. You can do partials. You can do this over a several year period. Again, don't disturb your natural tax rate. Okay, just do a little bit each year. Build up that Roth over time. And think, there's the only time I know in the tax law where you could do something and then change your mind. Let's say you decide to do a big Roth conversion, $100,000. Suggestion would be to break it up into two accounts. Let's say one's all equity, one's all bonds. You have a horse race until October of next year. You put your return extension, you pay your tax. Let's say the stock Roth went from 50 to 70,000. All right, I'll pay tax on that 50,000 because now the account's worth 70. Let's say rates went up and the bond account, which was 50, is down to 40. Now, why would I recognize 50,000 of income when it's down to 40? You don't have to. You can recharacterize it back to a traditional IRA and then re-Roth it again. And when you file a return, you'll get a refund for that piece. And it's like running the pick and roll with Mario Ginobili and Tim Duncan. It doesn't work. You rerun the pick and roll again. And you can do this over and over and over again. It's the only place in the tax law you can do this kind of thing. It's unbelievable. So when you're meeting with the people from Integrity, you need to have this on the agenda. Does it make sense? If so, how much? When? How? Be talking about this. Again, if you have legacy plans, you want to leave things to your kids and grandkids, this is what you want to leave them, is a Roth. No doubt about it. And if you have your kids that are working now, making a little bit of money, $20, $30, $40, $50,000, they're using all their money for their fun, okay? They're not interested in saving. They're not putting in the 401k. But you could gift them the money to fund a Roth, and that's where they should put it. Because they're in such a low tax bracket, it doesn't mean anything to get a write-off at 15%. Have them put it into the Roth. That makes all the sense in the world. Okay? Fund that Roth early. Okay? Estate and gift, pretty generous amounts now. I mean, a married couple, they could have $10.6 million, pass it on to the next generation, pay no estate or gift tax. $10.6 million. Okay? The exemption amount per person is $5.3 million. Okay? And that is inflation adjusted. The rate has gone up a little bit to 40%. And husband and wife have portability. So, sir, you didn't use any of your exemption. You pass on. You could leave the I love you will to your wife. She can have a $10.6 million estate. You put it over your exemption. Your executor fills out the form. $10 million exemption, no estate tax. But what if you remarry? Could happen. Sorry, she could remarry. She gets the new husband's exemption. So we'll check that out. Credit report, balance sheet. See if you used it. That was a joke. Come on, help me out here. Tax material's not that interesting. I can tell better jokes. Believe me. But taxes is hard to tell good jokes. But for most people, the portability feature is going to work. Most people don't have $10 million. Frankly, okay.
But isn't some of the estate based on the actual state in which you reside?
Interesting question. Very interesting question. This is federal tax law.
Right.
Every state has their own potential estate and inheritance. Pennsylvania has the inheritance tax law. It's hard to get out of that. Now, husband and wife, not a problem, but as soon as you start giving to kids, grandkids, and you got to pay. Well, they have to pay, essentially.
Can I ask a question? There was an article in the Wall Street Journal a few months ago about the fact that they sort of advocated maybe moving residency, if you could prove residency in a state where there wasn't an estate tax 6 months out of the year, that might be part of the conversation as you're doing. What are your thoughts on that?
That's a possibility. Let's face it, why some people move to Florida, for instance. Okay, well, that's one of the reasons. And, the weather's nicer, granted, but there could be tax reasons for that move too. But you really got to be a Florida resident. Believe me, New York is very attuned to this situation. Okay, because they have estate taxes.
Also, the state of Minnesota now, which I think is going to be a trend, if you even rent an apartment in that state, if you spend 30 minutes in Minnesota, they're going to hit you with a full tax bill.
Yeah,
So
yeah.
this Minnesota snowbird stuff going to Florida, Arizona, anywhere else, out the window now, and other states will follow.
Yeah. If you were going to try that tax maneuver, and believe me, a lot of people do, you better establish residency in Florida, which means you vote in Florida, you register cars in Florida. They could look at your utility bills. I mean, they can do Google. I mean, there's a lot of information on the internet. They know what's going on. Okay, the world is no longer a secret place.
A
So-
husband and wife, are you able to split it? One lives here, one lives there?
Well, yeah, each of you have an exemption. So one of you might be a resident, the other one may not be. Okay? So these are some of the planning points that you need to review with integrity. Each situation is, have to respect that. It could be different. Annual gift tax exclusion. It's not used enough. You could give anyone in the world $14,000. I can give everybody in this room $14,000. Don't have to file I know you want it. But everybody, it's not utilized enough. I mean, if you want to start reducing your size of your estate, you need to start gifting. Okay? Why hold on to this? You could give $14,000. You could pay for your kids or grandkids' entire college education. You don't necessarily have to put it in a 529 plan to write it directly to the college. Pay it right there on the spot. How much does Penn State cost for 4 years? I don't know, $80,000. Here's a check, $80,000. When Junior wants to go, it's paid.
It's a little higher than that.
Yeah. I'm not keeping up with the times, huh? Am I? Oh, he's going to get a little. He's going to get a little aid. He's a smart kid. He's going to get a little aid.
The 529, 529, does it, you talk about 14,000, that's excluded from my Pennsylvania income, right?
Yeah. There are some provisions.
Is this counted of that, or is it not counted?
It does count. It does count. So, by the way, if you decided to fund a 529 plan, you could put 5 years.
No, I know that.
Yeah. It does count.
Counts was the federally gift.
Yeah. So, but you could, if you put $14,000 in a 529 plan, that's their gift for the year. If you give them another $500, you got to pay. You got to file a gift tax return. You might not have to pay gift tax because you use some of your exemption, but you will have to file a gift tax return, required by
You
law.
have to file the other exemption for the rest of your estate just because you gave too much.
Well, yeah, you gave a little extra. Well, if you might, I don't think people hold on to these exemption amounts like they're never to be used. I say use them. It might make sense to use them.
I think that you're getting confused. Maybe if you're the account holder, you can put in as much as you want, correct? And it's not considered a gift per se.
Right. If
you're not the account holder, then you need to stick to the 14.
yeah, grandmom. Grandmom, you set up a 529 plan for your son. Your mother wants to put money in there. She could do $14,000, no problem. She wants to do And she could actually do more than that, because again, if she elects to use that, let's say front load the exemption, she could do up to 5 years. Quite a bit more than 14,000. Quite a bit more.
That's the business about that 5 million business, like, I do remember sweating hard, like, what is it, 2 years ago? My accountant, the last day of the year, I had to give everything I could to my different trusts or whatever, I don't remember, just to get to that number. But then nothing happened with Obama.
Well, things worked out. There was a lot of tax.
I guess they were trying to go from 5 back to 1.
Back to 1, yeah.
Yeah, there was we were very busy at SEI doing what, we did
Okay,
thousands
so
of.
now what's the scenario for 3, 4, 5 years, whatever?
This is the scenario. This is. There isn't any change on the forefront. Obama is on his way out, and he does want to. He's tried to attack this exemption amount, but there is absolutely no traction in Congress to get this changed. So under this current administration, Congress and President, I suspect there will be 0 tax changes of any major size affecting individual taxation. None.
So it was all the worry, but then it didn't happen.
It didn't happen, and
It doesn't look like anything's going to happen.
not under the next 2 years. I don't see any. The only thing that's
The
being
law was going to sunset, but
Sunset.
whether or not they could act in time to redo it.
Yeah.
That's what happened.
So we got a new tax law 2013. It's in place. Could there be changes in the future? Absolutely, but it won't happen under this administration.
But how much, last time was to the last day of the year, which is stupid, right?
It was past the last day of the year.
Yeah, when you have, you would give money, but you didn't know, just to be safe. But you're saying right now there's nothing, there'll be more warnings next time, basically.
Hopefully. I'll tell you what's going on right now. There were certain things that expired at the end of last year.
Yeah.
Okay, research and development, accelerated depreciation,
Yeah.
deducting
Payroll tax.
sales tax as opposed to state income tax, and one that pertains to people that get required minimum distributions. There was a rule last year that you could actually take your RMD and give it directly to charity and not pick up that income. You wouldn't get a charitable deduction, but you wouldn't pick up the income, which is much more valuable. That expired at the end of last year. And all those provisions are on the table, and the word around the campfire is that they're all going to get it back into law. But Congress, they move at a snail's pace. And it wouldn't surprise me it doesn't get done until the end of the year. Could be the last day of the year. Okay? Now, if you have clients or if you're inclined to donate to charity, and if you're of age to do this, you have to be over 70.5, I would go ahead and donate my RMD to charity. Now, the worst case scenario is you still have to pick up the R&D income, but you'll get the charitable deduction. Best case scenario is they pass it, and you won't have to pick up the income. Okay. And if you haven't taken your RMD and you just want to wait it out, wait it out. It'll be decided before the end of the year, but it could be several months more before we get an answer to that. Several more. Now, the big issue right now is on the corporate level because, and it's been exasperated by the Pfizer potential takeover of AstraZeneca. Because when Pfizer, if they're not going to, doesn't look like they're going to buy them now, but if they would have bought them, they were going to incorporate themselves outside the United States. And of course, that was a big, big deal because Pfizer has made a lot of money outside the United States, and it's all sitting outside the United States. And if they repatriate those dollars back in, they're going to have to pay a hefty income tax. But if they reincorporate and domicile outside the United States, guess what? It's no longer a problem. They call that an inversion. And they're not the first ones. There's been several companies that have already pulled this maneuver off. So Congress is like, whoa, daddy, this is a problem. We can't have our multinational companies buying some, in this case, that was a pretty big merger, but, I could buy any little company. And say, all right, now our headquarters is over here in Ireland or England or Cook Islands for that matter, and get out of a big, big tax. Because there's a lot of multinational, Apple has so much money sitting outside this country, it's ungodly sums of money. All right, well, let's say if Apple goes and buys, some tech company in Japan or something. So, all right, we're a Japanese company now. It's a real issue. Because all of a sudden we would not get that tax revenue anymore. So it's Congress, it's already been the Sander brothers have already been talking about this and trying to get something done. I doubt they'll get anything done, but it's on their agenda. And I do expect under the next administration that we get some corporate tax reform. It has to happen. This is bad, really, really bad. Okay.
Quick question. In order to gift something to somebody, they can't be a deduction, correct? So if you had an adult child that's still in college and you wanted to gift into a Roth IRA for them, you couldn't do that under a gift if they're still on your tax return.
That's fine as long as they have some earnings. They have to have earnings to make a Roth contribution.
Right.
But you can gift it to them, absolutely.
Okay.
Yeah, absolutely.
Even though you're still deducting it.
That's absolutely. Yeah, that was my suggestion.
You're not deducting,
Claiming it as an exemption. Claim it as an exemption. Regardless if you claim an exemption or not, you could still gift them the money to put into the Roth as long as they have earnings. So if they're working part-time during the summer, during their college years or whatever, as long as they're making money, fund it. Fund that Roth. Some of you may have a situation where you may have worked for a particular company, let's say Wesco. You worked at Wesco all your life, you accumulated some stock, and now it's in a non-qualified account. It's worth $1 million, and just for my example, zero cost basis. I have $1 million gain in this stock. All of a sudden you say, you know what? I don't want that risk anymore of that single stock position. How do I get out of it if I don't want to pay the tax? Well, there's a way. Now, what is the tax? Well, $1 million gain, if it's a long gain, 23.8% federal, add the state tax another 3%, $268,000. Who wants to pay the $268,000? Who wants to get the checkbook out? You might not want to get the checkbook out. Now, mind you, if you transferred that stock position to a charitable remainder trust and then sold the stock inside the trust, guess what your tax bill is? Bubkiss. It's zero. Technical term. Now, as part of that deal, you will receive a payment out of the CRT, for instance, as long as you and your wife live. Because that's one of the, or it could be a term of years. Or it could be based on a single life. Minimum payout of a CRT is 5%. Could be considerably higher, depending on your age and the circumstances. Okay? Not only that, you will get a charitable deduction for that contribution. Not $1 million, mind you. It depends on some factors. But you will get a nice charitable deduction. And it could be pretty sizable, $1 million gift. It could be $250,000, $350,000, not sure. Have to run the numbers. But I said, well, I can't use that on my return. Well, if you can't use it all in the first year, you get a 5-year carry forward. That's how you manage income. Instead of paying $268,000 in 1 year, I'll put it into trust and sell it, then I'll be picking up income out of this trust over several years. And it'll be tax-favored income. It'll be capital gain income for many years. And only pick up a little bit of income. You do need to name a public charity on the back end, because 20 years later, you and your wife happen to pass on, United Way is standing there to collect whatever's in that trust. Now, mind you, they don't have to get anything. It just has to be designed that way. I don't know what the future holds. 30 years from now, the trust could be empty. Charity will get nothing. But you got the tax benefits right up front. You got the charitable write-off. You got out of the big tax bill. Okay, and you got the annuity coming out of this for a lot of years. Very powerful from a tax planning standpoint. I'd rather pick up a little income for many years than a big chunk of income in 1 year. Question?
Why is the payment from the CRT to the donor capital gains, not regular income?
The reason why, that's an excellent question, is because, well, there's two, I'll give you two possible. The reason is, when we do that transaction, we invest in very tax efficient investments. And what happens is there's a tiering system in trust. So the first thing that will come out is ordinary income. But if you don't generate any ordinary income, there's none to pay out. The next layer is capital gain, then municipal interest, and then principal. So if I don't generate any ordinary income or very little, then what's coming out will be capital gain income. You follow me?
The CRT sells the stock.
That's right. And there's a big gain that we just recognized in there.
Does it have to sell the stock?
No, it does not have to sell the stock. But that's normally the reason why you put it in there in the first place.
Diversify.
Yes. Now you could put real estate in here. You could put shares of a partnership, a closely held C corporation. You cannot put S Corp stock in here though. A CRT cannot be a shareholder in an S Corp. Okay, it's very powerful from a tax planning standpoint. And then, of course, pairing this with a Roth conversion can make a lot of sense because you just created this huge charitable deduction. You marry that with a partial Roth conversion. There's a lot of interesting tax planning ideas here. We do a lot of these at SEI. We do a lot of these.
Overhead for this?
Huh?
What's the cost, the overhead?
Well, let's talk about that. It's a good question.
Does it work?
Well, there's a couple costs. One is a one-time cost. You do have to need an attorney to draft a document, a charitable remainder trust document. So what's that? $1,500, $1,800, whatever that cost is. One-time charge. It's a boilerplate document. There are flavors of this. There's a lot of different nuances to it, but a boilerplate one. Now, for us, when we do a CRT at SEI, there's a $2,000 annual flat fee for full trust administration. You get your own trust officer, and we do the tax return. For all for that for $2,000. Of course, there will be money in here that needs to be managed. Okay, so integrity is here. So there are going to be underlying investment costs and, of course, integrity's fee. Okay. But that's standard. I mean, it's just like any other account. Extremely reasonable. Now, if you take that same $1 million trust and take it to some bank around here, they're not going to charge you $2,000 flat. It'll be more like $10,000 to $12,000. It'll be a percentage of what you put in there. And then again, there are investment management fees, et cetera. This is we're the best bargain in the street when it comes to trust services, by far. By far.
Wait a minute, because the CRT, the donor cannot control the CRT, or what the CRT does?
Absolutely, you can control.
No, I mean, you have to go through a trustee.
Yes, there will be a trustee.
So the trustee is you.
Yes. Now, let's say you want to be co-trustee,
Yeah.
or you want like someone that you know and trust to be trustee. Then our costs go up by $1,000 a year instead of $2,000 a year, $3,000 a year. But you can certainly direct the investments, and you can certainly direct who the charities are, and you can change them at any time. But this is a one-way street, ladies and gentlemen. This is an irrevocable gift. So you go from here to here. You call me up a month later and say, I changed my mind.
Too late.
Yes. I'm sorry. The only way you're going to get any money out of here is through those annual payments, or the charity gets it. Okay. But it can be very helpful when managing a big tax bill. Very helpful. And we have another flavor of this where it's called a charitable lead trust, where we reverse the transaction, meaning the charity gets the money each year, okay, and then your heirs get it on the back end. That's called a non-grantor lead trust. We have some clients that are extremely wealthy who don't want to pick up that income on their tax return anymore. So what they do is they take those income-producing assets and put it into a trust, and whatever income is produced is given to charity. Now, I have many people who do this who are not charitably inclined because they see the tax benefits and they go, I'll do it. Okay, they're just blinded by the tax savings. But to do a lead trust, you definitely have to be into charity because that's who's going to get the money for the, let's say, 5 or 10 years, and then your heirs will get it afterwards. So, but I have a lot of people that I look at their tax return and they can make $1 million and give $2,000 to charity. I wouldn't call them charitably inclined. They see this, all right, let's go, let's do it. Okay, it's totally legal. It's been done 1 million times. But if you're charitably inclined, all the better. Because, you can put your college there or something, you can certainly announce it and say, hey, I'm leaving you a trust. And all of a sudden you're written up, hey, look at the big donor. It's important to some people.
Does the CRT is limited to the charitable deduction and also the fact that the charities might not be deductible soon?
Say that again?
Is the CRT, you can only deduct 30% of your AGI, I think.
Yeah, there's different limitations. There's a 50% if you give cash. Now, when you do this, it's 30%. But then, like I say, whatever you can't use this year, you have a 5-year carry forward. So whatever.
Follows that same law as giving it.
Yes, yes. Let's say if you decide to put that stock instead of into a charitable remainder trust into your private foundation, then it goes from 30 to 20% limitation. And if you're going to do a foundation, you better really be talking big money, because it's more complex, more filing of tax law and things of that nature. I'm not saying against it. I'm just saying, $1 million of CRT. You can do a CRT for as low as $250,000. Most of the times I see it, it's usually $500,000, $1 million, $2 million, somewhere in that range. Private foundations, you're looking 5+. 5+. But very powerful, and you should run the numbers, see what it does, what it looks for you. It can make a lot of sense. Again, you don't have to put all the stock. You can sell some on the outside, sell some on the inside. But it's good for all types of assets. Anything that's appreciated. You wouldn't put cash in here, let's put it that way. That's not a good asset to put in here. You're trying to shelter a gain.
How do you shelter an income though? It's impossible.
Well, I just gave you the example, charitable lead trust.
Income, yes, sir.
Charitable lead trust is shelters income. Shelters income, and it's also part of an estate freeze technique, because if you do a non-grantor lead trust, your heirs will eventually take over that property. And if the property, while it's in the CLT, appreciates, okay, that's estate tax free. Okay, that's estate tax free. And there's other trusts we can do: granted retained annuity trusts, grits, grats, nings, dings, krats, kluts, nimkruts. I have the whole alphabet of these things. Tell me your problem, I'll solve it. Okay, I'll solve it. That's why they call me the tax doctor. Bottom line is, it's important that your next meeting, you bring in your tax return, have it reviewed. See what tax savings we can identify. You actually don't want me to find anything. Frankly, you don't. It's like going to the doctor and they draw blood. What do you want them to tell you? You got high blood pressure, you know, your hemoglobin's out of whack, your lipids are going through the roof. I don't want to hear that. Oh, you're an ox, you're going to live to 1,000 years. That's what I want to hear. But what if there was a problem? Would you like to know about it? Would you like to get medicine to remedy the situation? Well, that's what we're doing here. This is like a financial checkup. You get a physical, which is a medical checkup. This is the financial checkup. Review your brokerage statements. Review your tax return. Is everything where it should be? Is it managed properly for taxes? Life is good. Now, I am a tax person, but I am also a marriage counselor. Now, I've only been married 5 years, but I have identified how to have a happy marriage. And I'm going to impart that knowledge as a free bonus to you tonight. Well, twice a week, my wife, we go out to dinner. Nice bottle of wine, candlelight, good food. I go on Tuesdays, she goes on Fridays. It's working out magnificently. And with that, I'll take any additional questions. Enjoy the wine, enjoy the sandwiches, have fun. Thank you.